Hello everyone and welcome to the Tortoise channel. Today I want to discuss another one of my holdings, and that is Evolution AB, which I haven't discussed in great length, but I do intend to do that with today's video, and that will include discussing the fundamentals and also what's causing the price to come crashing down, which has been happening ever since 2021, as you can see, and now we are trading at $77 per share, give or take. So it's been a major drawdown, and the question is, do I still think this is a good investment at current prices? What do I think about the long-term prospects for the business? So let's discuss that. And you know that I'm always very transparent about our portfolio holdings. I created a Tortoise portfolio exactly because I wanted to make this record visible for everyone to see exactly how we teach what we preach and we preach what we teach. And sure enough, we follow a very concentrated approach to investing, and we only own companies we have a high conviction in and bought with a significant margin of safety. And you can see, going back to almost 2 years ago, to January 2024, that we have achieved a 61% rate of return. That's about 32% compounded, which is incredible. And with only 6 positions, and none of them are high-flying tech names like the Max 7 or speculative assets like cryptocurrencies. Okay, so let's talk about Evolution, which you can see here that together with Lululemon is in the red. So I'm currently down on these 2 positions, and let me discuss Evolution AB. So what are they? If you have been following the channel for a while, you know that I'm all about delving deeper into a company before deciding whether or not to make certain investments. And Evolution AB is no exception. You can see that one of the reports that I shared with our community on school was Evolution AB's report, which includes always the 15 questions. I call them the 15. Well, how many are they exactly? I think it's about 12 questions that I always want to give answers for, and while doing my own due diligence. And you can see that the first one is always, do I understand the business model? If you can't understand how the company makes money, then you have no business investing in that company in the first place. And so it all starts with that question that sounds logic, but it's very, very powerful, right? So we have to understand that. No matter what the company or sector, I always raise the same questions, which lead to a final question where I try to answer. I try to give an answer as to whether or not I believe we should invest in the company today, right? And of course, because I always put my money where my mouth is, most of these companies I write about are high quality. They meet the high quality standards that we are on the lookout for, and many of them are in our portfolio. Yeah, if they are not, that's because they are either expensive or because there are only so many companies that I want to own at a single point in time. So you will never see more than 7-8 companies in my portfolio, because it's very difficult to track all of them very well the way I like to. Okay, so let's start with the basics. Do I understand the business model? And what is Evolution AB? They are a leading B2B online gaming service provider. And you can see that, so they are not a casino operator. They simply license those games to gaming operators. Okay, so they are not, so they don't have a relationship with the client. What they do is business to business, and then the gaming operators will then offer these games to the clients. That's already business to consumer. Right. So this first established in 2006, the company was one of the first providers of B2B live casino solutions in Europe, having since evolved from a rudimentary live casino roulette game to a comprehensive ecosystem of live casino games tailored to various player preferences. The core of its offering includes traditional table games, roulette, blackjack, and baccarat. And you can see that today Evolution operates studios across Europe, North America, where they have been expanding aggressively, as we will discuss later on, and offers the industry's most comprehensive product portfolio, having been named Live Casino Supplier of the Year 10 times out of 10 at these awards. So they have over 600 operators, including most top-tier online operators, platform providers, and several land-based casinos. And some of their partnerships include names like, for example, DraftKings, MGM Resorts, which I'm also familiar with, and the Wynn Resorts. So all in all, the company's business model revolves around offering innovative gaming content and platforms to casino operators, monetizing through licensing agreements and revenue sharing agreements. This is very important because once I answer this question and I understand how the company operates, what the business model looks like, then the second question is, okay, so how can I break down the revenue model? How exactly do they make money? And you can see that the bulk of their revenues come from the live casino segment. That's their core revenue stream. How does that work? They stream live table games such as blackjack, roulette, and then casino operators integrate the live casino solutions into their platforms. This segment involves a live dealer in an Evolution studio conducting games and dealing cards. So the revenue is generated via revenue sharing agreements. They earn a percentage of the operator's gaming revenue and also fixed table fees. Operators pay for exclusive or customized table. What I like about this after delving deeper into the financials and the annual reports, is that Evolution, the business model is quite scalable. In other words, because they are doing all these live games, there are no limits to how many people can be playing those games. And this allows Evolution AB to spread their costs out over a larger customer base, which is very scalable. And well, I mean, it creates a lot of operating leverage over time, which helps explain why their margins are staggering. Okay, so other segments include live game shows, contribution to total revenue 20%. You can see that live accounts for about 90% of total revenues, which is pretty significant. And then we have online slots at contributing about 10%. Okay, now here's the geographical split. You can see that most of their revenue come from Europe, about 39%, with Asia falling in second place, North America at 12%, and then we have Latin America and others. And it's nice to see that the company is expanding a lot worldwide, but certainly in America and in Latin America. In fact, they opened 2 new studios recently, one of them in Brazil, which to meet rising demand, as we will discuss as well. Here are the main customers. And what I like about this right here, you can see that the daily average players of Evolution Gaming's games have been going up. Why is this important? This is one important aspect that drew me to this investment thesis, and that is demand for their games, which is the core of their business, right? To produce and to supply those games, demand has been going up. That tells you there is demand. That tells you that the sustainability of the business, right, is intact. Yeah, because the core of what they do is exactly that. They produce those games, they sell them, and players definitely like those games because the number of daily average players has been going up steadily over time. And then I try to answer another important question, and that is, do I think management is capable? And before we delve into that, let's talk a bit more about the companies. Let's talk a bit more about what do I wanted to show you guys about. Yeah, okay. So these are some of the events that events after the reporting period. So last time they reported, you can see that these are some events that that are noticeable. In like as I was saying, studio launched in São Paulo, Brazil. So they are opening new studios internationally, but especially in the United States, so in North America and Latin America. And you can see that they enter Rhode Island in the US with online game slots. So this is a company with a lot of runway for growth. And that is essential because it means the company has a lot of reinvestment opportunities going forward. And that's part of the thesis. I want to invest in companies that can have a long runway for growth, because that means they will be able to reinvest a lot of their profits back into the business and scale over time, right? And that's what I want. No dying industries, in other words, even though you can find great companies there as well. So what about management? You can see that the CEO, Martin, has been with the company since 2015. And more importantly, this guy, on top of knowing the company and industry inside out, he has a lot of skin in the game. Let's see that. If I go here to Stock and Lock, and if I go to insiders, look at that. Insiders own about 24% of the company. This guy, Darth Kenneth, is a billionaire. He was buying the company hand over fist not that long ago. In fact, if I go back to insider transactions, I'm not sure. These are all insiders, of course. But if I go here to ownership, I should be able to see something here. Darth Kenneth. Yeah, so I could see that he was buying the company a lot over time, but this means that initially I think he had about 14% of the company, but he took advantage of this dip, and he increased his stake in the company, which is substantial. That's almost 70% of the company, 17%. It tells you that he's bullish on the company. And also, you can see insider transactions are very bullish because insiders, namely the CEO, have been buying the company hand over fist with their own money. All right. So this is important. And for example, Martin, you can see that, and I mentioned that right here, you can see that he owns more than $63 million worth of shares, which is significant if you contrast that with his yearly salary. Okay, so a lot of skin in the game, and I love that, because it makes our interests aligned. And so I really like that, okay? And that means because since 2015, the company has witnessed explosive growth, and these are the same people that were at the forefront of that innovation, of that growth, right? The other question is, do I think the company has a sustainable competitive advantage? And the answer is absolutely. Otherwise, I wouldn't invest in it. Number one, they benefit from the first mover, right? So they were the first company to enter the live casino space. So they have that first mover advantage. Market leadership in casino, first mover advantage. By focusing on live casino early, Evolution established a strong presence in a high growth segment that competitors are now trying to enter. And that's very difficult, because what happened is, over the years, they've built partnerships with many companies. As you can see, strong relationships with casino operators, and that creates stickiness among those casino operators, because once they integrate Evolution solutions into their systems, it's just, look, it's hard, especially if there is growing demand. Why would they cut ties with Evolution? That just doesn't make any sense, right? On top of that, Evolution takes care of all the hard work, from coaching their dealers to setting up the studios. All of that takes a lot of expertise, and so all of that takes years to build. So they have a big competitive advantage in that regard, and not least because of they enjoy an extensive global reach, right, and regulatory expertise. In fact, regulatory headwinds are part of the reason why the stock has come down over recent years since 2021, and that has been part of the bearish thesis, is that the growth that the business enjoyed in the past will no longer happen in the future. Of course, I'm skeptical of that. All right. So economies of scale, we already discussed that. And by the way, guys, if you want me to send you this report, just let me know in the comments, and I'm more than happy to do so. Okay. It took me a lot of time to do that, but this just I just try to understand the business as much as I can. But for the sake of time, I will try to be brief in covering only the essentials. Now, is the company active in an attractive end market? Take a look at this. The online the gambling market from 2025 to 2030, you can see that this market is expected to grow at a CAGR of 12% from 2025 to 2030. That's amazing. So the company is active in a very attractive end market, and because they are the leading player in this field, I believe they will stand to benefit from this growth, and they will capture a lot of that, which will ultimately translate into revenue growth and profitability. Okay, that makes me very, very, very bullish. And over the years, Evo's revenue generated more, increased. That is not as important. But of course, regulated to untapped markets, many regions, including parts of Asia, Africa, and Latin America, remain underpenetrated, offering significant room for growth. Also, legalization. Governments worldwide are legalizing and regulating online gambling to capture tax revenue. So one of the risks that investors point out is that with regulations, there is the risk that the company's business model will be breached. So, in other words, if they start regulating the industry, there may not be a market at all. They will make it difficult for the company to grow, right? Because in the case of Evolution, and the majority of their growth still derives from unlicensed markets. Okay, and so, but that is slowly shifting. So the company wants to make sure that they follow the regulations, and now, and that part is now shifting, which is going to be very important. And of course, Evolution made some mistakes probably initially in that regard, but now they are targeting more licensed markets because regulations are actually good. Because they create transparency, they will attract investment, outside investment as well. And I think that's going to be bullish. So, for example, many funds may be reluctant to invest in Evolution exactly because they know this industry is not as regulated as it should be. And so that exposes companies that operate in the industry, especially if they generate a lot of their revenues from unlicensed markets, which is still the case of Evolution, even though they are starting to shift that. Okay, so this is the competitive landscape. Evolution is the clear leader in an oligopolistic B2B market, primarily contested by Playtech. But when you compare the margins, I mean, these companies are so wide apart. It's almost unbelievable. Just take a look at this. Evolution Gaming's market leadership with an estimated live casino market share of approximately 70%. They are the undisputed leader. And so I think this will continue as they continue to provide great games and people become more attracted to them. Okay. What are the main risks for the company? Regulatory risks, that's always important. global compliance complexity and market restrictions. We have to pay attention to these. So going back to the stock has crashed substantially. Number one, because the company has faced cybersecurity, cyber issues in Asia, which caused its revenues to remain flat for a long time. Okay, and in Europe, and don't forget that Asia is very important for Evolution, right? A big chunk of the revenues is generated in Asia, and also Europe, because in Europe they have taken. The company itself has taken. They try to front run regulation in Europe, and now they are slowly implementing important regulatory frameworks that will allow the company to have a more sustainable business in that going forward. All of this takes time, takes money, which understandably has taken a toll on profitability, as you will see. In fact, let's jump right into that. Look at that. Yeah, now this is the summary of the second quarter and first 6 months of 2025. I want you guys to focus on the first 6 months of 2025, and you can see that revenue, as you can see right here, the growth slowed significantly. They reported a 3.5% increase in revenue, as you can see. And this is a company that was growing, as you can see here from my spreadsheet, that was growing revenues at 44 and 47% over the last 5 and 10 years, respectively. That is a significant decline, okay? So the company is decelerating a lot on the back of the issues that I just highlighted. And I do think they create short to medium term headwinds, but I don't think they are how can I say, I don't think they are intrinsic. So I don't think they are related to the company in specific. That's what I meant. Which would raise important red flags if that was the case, right? Because you don't want to see that. You want the business to remain sustainable. And again, if I look at profit for the period, look at that. That's a decline of 6.6%. And of course, the profit margin earnings per share also declined 3.6%. So this is didn't make investors particularly excited. But what happened, what strikes me is that even against the backdrop of this slow growth, the company still boosts stellar margins. And so if I go here, by the way, they have a 4.556 score on Evolution, on Stock and Lock. And if I go here to the metrics and we check their margins on a trailing 12-month basis, you can see, look at this. So we have, these are their operating margins. Look at that. Only a slight decline, but still at 62.53%. That's incredible. And if I go here to the net margin sitting at 53.73%, the fact that they have been under pressure has happened before. And so this is not really a cause for concern because these margins are staggering. They are really high. Tell me another company with such incredible margins, and I will be appalled. So very good. It's hard to understand how a company like Evolution is trading at such a steep discount, even considering all the risks. And if I go to free cash flow margin, look at that. That is already declining a bit more because the company has been investing into growth, but still at 50.62%. These margins are incredible. And by the way, if I go here to the total revenue, you can see that revenues continued on the way up, which is very bullish. Likewise, you can see that net income has been going up only with a small dip recently. But certainly no cause for concern. In fact, let's discuss that right here. Yeah. this is the balance sheet, but yeah, I want to cover. I want to cover the rest of the income statement, and also in the income statement, as I put here, you can see other things. For example, if we do, let's check other some valuation metrics, as you can see here in my sheet. For example, the earnings, the PE ratio are still quite high for a company with this track record. So definitely the market is discounting a lot of risks going forward. But when you pay 12 currently they are about 11 times for a company of this quality. I mean, even banks are priced more expensively, let alone a company that has such a capital light business model with such a great runway for growth. So this is ridiculous in my opinion. Same happens with all the valuation metrics. Price to free cash flow is high because the company, like I said, is they have been investing a lot into growth. In fact, if I go here to free cash flow, you can see that. So let's go here to free cash flow. And you can see that free cash flow has dipped a bit, yeah, from 1.23. In fact, this is the yearly. Yeah, it's still high, but on a trailing 12 months basis, it dipped from 1.23 billion to 1.14. And of course, CapEx was also higher. Where is it? CapEx. Okay, look at that. CapEx rising a lot. So the company is investing a lot into growth. Most of this CapEx is growth CapEx, not maintenance CapEx. We can use the depreciation and amortization as a proxy for the maintenance CapEx, and you can see the difference is substantial, right? So the company is opening new studios. They are opening studios, and that of course that certainly costs a lot of money and explains that difference. So all in all, you can see that CapEx is quite CapEx as a percentage of sales and operational cash flow is low, and look at debt, very low as well. So the company has no problems there's no solvency risk, certainly no liquidity risks either, and yet the analysts are projecting about 9% growth. In fact, 9% growth over the long term. So that tells you they are very negative, but rightly so, because these past growth rates are well, a thing of the past. But I do believe the company will over time be able to at least grow at about 15%, and that's part of what makes me bullish. Okay, so those are things that I wanted to discuss with you guys, and also to note that the company has a net cash position. All right, so when you subtract total debt from total cash, you get a net cash position, which is very good. Not all companies not all companies have that, and that's something that I do like. And of course, because the company is so profitable, it's so and is trading at such at lower valuations. Look at that. Our shareholder yield, if we buy the company right now, is about 7%. Yeah, total shareholder yield. The earnings yield alone is about 9%. So if we bought the whole company today, this is how much the company could return for us in earnings every single year. That's crazy. Okay, and look at the free cash flow yields. Yeah, very, very good. And on top of that, the company also pays 50% of its profits in dividends, and they have grown dividends year over year at about 11%, solid growth. Okay, so lots of things to be excited about, and I want to discuss valuation right now. Okay, so I like I said, so I just tried to cover the most important things about the company, but I'm already 32 minutes into the video, so I know that I have to cut this short to avoid boring you guys. But if you want the report, let me know. Now I'm going to jump straight into the valuation and why I think the company is a buy at today's levels. I'm not going to focus on the margin of safety method because, as you know, the margin of safety method, if you have been following the channel, you know that this is more applicable to companies that have been growing at about 15 or above 15 or over 15% per year. And the analysts are only projecting 9% growth, which of course leads to a very depressed valuation level. It's not really accurate. So let's focus on payback time and 10 cap rate owner earnings. What are these? I learned this from Phil Town. I joined one of his webinars about 5 years ago, and it was very, very insightful, to put it lightly. I learned a ton. And I had just incorporated these three methods as part of my analysis, as part of my valuation framework. So payback time tells you how long it takes you to get your money out of the business in earnings or free cash flow if you were to buy the entire company today. Ideally, you want to get your money out in about 8 years. So you can see that free cash flow in year one is about 1,212,000,000. If we grow this at about 10% per year over the next 8 years, and if we then sum up all the cash flows, we get about 15 billion. And if you divide that by the number of outstanding shares, you get an average price per share of about 74, which is exactly the price that Evolution trades at today, give or take. And if we do the same for earnings, you can see we get about 74 as well, because this is something that I really like, the fact that free cash flow and earnings are just about the same. And this tells you that there is little manipulation cash is king. I prefer to prioritize cash, but seeing both at about the same level tells you that there is little to no manipulation, and this makes me it's a big positive, right? And let's talk about the 10 cap rate. So 10 cap rate is conservative because it doesn't include any growth rates. Where you start with the operating cash flow, you subtract maintenance capex, which is typically about 70% of total capex, and then you add the tax provision, and you divide that total owner earnings by the number of outstanding shares, which gives you 7.90. And if you multiply that by 10, that gives you 69, which is essentially it means that if you buy the business at about $69 per share, that's about a 10% yield that you'll be collecting without counting with any future growth that the business will certainly have going forward. So all these methods already have a 50% margin of safety built in, and you can see that the company is trading well within our range, and that's why I started accumulating shares not that long ago. Okay. So I have a significant margin of safety. And sure enough, if I even go here to my reverse DCF, you can see that I always want 15% on my money. So let's put that as my discount rate. Here you have shares outstanding, and then we have free cash flow in year one. And let's assume the free cash flow grows at our projected 10% over the next 10 years. That leads to an intrinsic value of about 72, which again is within the range that we are discussing. Okay, and this tells you that the market is very conservative as well, because over time I do think Evolution will be able to go back to at least 15%, and that will significantly increase the intrinsic value. But even if you pay at 72 today, and if the company grows at your projected 10% per year, that means you will have your 15% per year over the next 10 years. All right. So look, I'm bullish on the company. What can I say? I think there's a lot going for it. And I like to see that management has a lot of skin in the game, so they do believe in the business as well, which makes me excited. And I'm looking forward to the next earnings call and to the next report to see what management has to say about the headwinds they are facing both in Europe and China, and see if the company can once again spark that growth, some of that growth that made them famous. All right. And yeah, let me know if you guys like this video, and let me know. Just smash the like button. I hope it was insightful. And let me know if you want me to, what other videos you want me to record, if you have any other preference, and also if you want to report, don't forget to mention that in the comments, and I will share it with you gladly. And yeah, if you find helpful, also make sure to subscribe and to share the video, because that will definitely help the YouTube channel. You have a great rest of your day, guys. Thank you.